Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we consider a different aspect of the craft using the techniques honed by the man widely considered to be the father of the craft, the one and only Benjamin Graham. In this episode, we should be looking into the implications of artificial intelligence on the investment landscape. Consider if it is likely that AI can go on to perform the task of active stock picking better than humans, and how this is likely to impact the work of the value investor. As always, we'll look to see if Graham's books, The Intelligent Investor and Security Analysis, can shed any light at all on this very modern issue. So without further ado, kick back and prepare yourself for another lesson in value investment as inspired by Benjamin Graham. We've all heard the news. Very soon, AI robots are coming for our jobs. It's a no-brainer really. Robots don't ask for pay rises, time off or medical insurance. And it's only a matter of time before they will be able to perform a variety of tasks better than we can as simple skin and bone. Why would you employ a mere mortal when a robot is cheaper and more efficient? It seems obvious enough to assume that of all the jobs that can be replaced by AI bots, professional stock pickers and asset managers may well be first in line once AI programs reach a certain level of sophistication, given that computers are much better suited to the crunching of numbers than they are emptying trash cans or serving up flat whites. And that time does not feel like it's too far off. The use of computer programs to assist in investment decisions is of course nothing new in the stock market. Those in the industry have been using ever-increasing computer power to assist them with their investment decisions for decades now. So in that sense, what we are seeing with AI now is simply an evolution of those very basic early digital tools. However, what we're beginning to see now are systems so advanced that it will soon no longer need human involvement at all. The benefits of this state of affairs is obvious enough. Why would investment houses employ experts on seven-figure salaries if a bot can do the job better and more cheaply? Bots are cheap, they can potentially crunch the data better, with better rates of accuracy, they don't suffer from biases, and they don't release any noxious gases, which is an added bonus if you happen to have to share a room with one. What is not to like? If you run an investment house, would you really feel sentimental enough about the old way of doing things to stick with your highly fallible and expensive human brains? I thought not. So if we can say that it's highly likely that soon enough the decision whether to buy or sell stocks will be taken not by human beings but by cold, dispassionate robots, then where does this leave the value investor exactly? Is it inevitable that the artistry of selecting undervalued stocks will go the way of the dodo? Or is there some hope that despite AI programs they can be trained to do a better job of crunching the data to uncover those bargains out there, that they will always lack the special human touch of an investor trained in the art of value investment? Whilst AI investment bots are likely to become seriously impressive over the coming years, it is unlikely that they're going to have things all their own way. Whilst it seems inevitable that bots will increasingly do a better job at objectively valuing a business, they are unlikely to be any better at predicting those unknowable future events that send markets into a spin. It seems beyond the scope of machine learning now or in the future to foretell precisely what that future holds. Could an AI bot ever be able to predict something like the 9/11 attacks, the COVID pandemic, or the Russian invasion of Ukraine? And even if it was able to, could it say for sure the exact impact it would have on the world economy and stock prices? This fact is an important one when considering the sustainability of the value method. For it is the noise created by events that has the scope to alter the global picture that is the main driver of mispricing. After the 9/11 attacks, many airline stocks in America dropped by over 40%. But the truth was that analysts and investors did not have any idea what the attacks meant for the airline industry. It was such a fast-moving and unprecedented chain of events, how could they? But could AI really have done any better? I don't think so. This matters because it is these very unpredictable events that drive stock prices to levels far out of line with what a business is fairly worth. And if AI cannot do a better job than their human counterparts, then value opportunities will continue to exist. Investment bots are likely to be hamstrung by yet another factor that makes life so difficult for their living, breathing predecessors. Whilst it can be assumed AI bots will be better able to control their emotions, meaning that unlike the human fund manager, they will not be hampered by their own psychology and propensity to panic unnecessarily. They do not have the ability to control the emotions or behaviour of the humans whose money they have been entrusted to allocate. If and when the regular dramatic events and situations arrive, triggering the angst of their human clients, then just like the human fund manager, AI bots are helpless to avoid withdrawal requests, meaning that they'll be forced into having to sell stock at potentially disadvantageous times in order to return the funds to the customer, even if their logic screams for them not to sell. Likewise, if their human clients happen to be in one of their euphoric periods over the prospects of a booming stock market, then they must find stock in which to invest regardless, even if the lines of their code tell them there is nothing worth buying. Rational AI bots might very well be, but slave to the whims and the foolish actions of their sentient brethren they remain. And so will remain opportunities for the value investor to take advantage of their clients' foolish actions. This brings us back to Graham's analogy of Mr. Market, the manic depressive who can't quite decide whether he should sell to you at an unduly low rate or offer to buy your stock at a price way above what is sane or rational. The AI investment bots might not like it, but through their customers' actions, they are forced into mirroring Mr. Market's foolish ways. As well as the likelihood of all the bot's hard work being in vain, as its clients continue to undermine it through emotionally driven trading, the question also has to be asked what these bots will actually be asked to do, because ultimately this will be decided by their human bosses. Will they be asked to look for the undervalued opportunities as beloved by value investors, or will they be trained to seek out the next big growth story? AI bots seem best suited to the examination of data rather than deriving investment decisions through the consideration of mere qualitative opinion, and so it instinctively feels that bots will be better placed to undertake value investment duties. But what seems more likely is that they'll be asked to hunt out the next Google, which is not necessarily their best skill set. The issue here is that judgment of qualitative factors is notoriously difficult for man or machine, as it is much more of an art than a science. I cannot fathom how an AI program can arrive at a meaningful conclusion when asked to judge something like the quality of management. What exactly would it be basing its conclusion upon? Past records perhaps, but then you come up with issues as highlighted by Graham. He stated that there is a strong tendency in analysis when considering what value a management team brings to a business of counting this management factor twice. A successful business may be trading at a high price because of the large earnings produced by good management, plus separately a substantial increment for good management itself. Graham concluded that pricing in the good results achieved by the management team, then adding an extra supplement simply for achieving these excellent results, means that the investor would be paying double for the factor of good management. Good management, like all qualitative factors, is also highly subjective. We've seen in the past examples of managers being considered the best in their field, but stars can quickly fall and reputations diminish. We saw this with Jack Welch at General Electric, who was a superstar manager of his day, but his legacy has subsequently been a difficult one. So how do we conclude today's podcast? First and foremost, we can say that AI is certainly going to change the investment landscape. We are going to increasingly see bots replace those who make decisions of what to buy and sell on the stock market. On the face of it, given that machines are much more temperamentally suited to the act of investment, this should mean we see much more efficient markets. And if stocks are priced more fairly, this of course lessens opportunities available to the value investor. But as we've already considered, there are some unalterable facts that will stymie AI's ability to accurately value businesses. AI bots will still be at the mercy of their human clients when it comes to being given funds to invest or being asked to return those funds. This means that bots must still find a home for funds even if there is nothing out there worth buying, and they must enact a fire sale and sell down because their customer has entered a period of panic about the latest piece of unsettling news. Both instances will result in the mispricing of stocks and create opportunities for the value investor. As well as this, it remains to be seen just how good bots can become at interpreting qualitative data. This type of data is notoriously difficult to draw conclusions from, as so much of it is based on mere opinion. Did Amazon succeed where rivals failed because Jeff Bezos was a great manager, or was he lucky and happened to be in the right place at the right time? What if Bezos has actually held Amazon back, and if they had a better manager in, it would be twice as successful today? Even if we concede Bezos was and is a great manager, what would this have meant in dollars and cents? How much would the AI bot have paid for him? Likewise, Coca-Cola has an outstanding competitive advantage, but what to pay for it? These qualitative judgments are just that, a judgment, and I feel that it's unlikely that AI bots are going to be any better at it than their flesh and blood predecessors. All this then is encouraging and good news for the value investor. For markets are just as likely to be prone to boom and bust as they ever have been, and opportunities for the value investor should remain abundant. As Graham points out, investment in all its forms is part art and part science, and whilst machines can do the science part very well, there are far too many factors pulling and pushing on the qualitative outlook that require an artistic interpretation to draw reliable conclusions. Our jobs are safe for now. On that, I shall wrap up this episode. I do hope you've enjoyed it. If you have, you can do me a favour and add to playlist so that you need never miss any future editions. Join me next time when we look at another lesson in value investment as inspired by Benjamin Graham. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.